Keith, a lot of pundits are trying to pick the bottom in the equity market, but Hedgeye, based on your data, you've got growth and inflation decelerating into the end of the year and even into 23. So based on your experience with bear markets, all of which you've called since 2008, where are we, do you think, in terms of wringing out the excesses from that epic bubble that peaked last year? And how much more work does gravity have to do here?
It's the toughest question to answer, Mark, because the primary answer is I don't know. But every day, God willing, 2 feet on the floor and 2 hands on the keyboard. My job to risk manage and handicap that with rising or falling probabilities on where the severity could take us, or where we could get a lift, or where it actually ends. Picking bottoms, like you said, it's kind of like a stinky business, as we joke, but it's not easy. It's a process. Like bottoms, like tops, are processes. They're not points. And this one had so much excess and such a breadth to the excess. And I mean, from the credit market bubble to the crypto bubble to the bubble in mega cap stocks, I could go on and on, SPACs. That really, I think I don't know is a really responsible answer. And if you've been on the right side of this, which many people in our audience and our community have been, there really shouldn't be a rush to call a bottom, because again, A, you don't know when that's going to happen, and B, it could take a lot more time.
Based on Hedgeye data, are there 2 or 3 data points that are the most telling about the current environment? Would it be the inverted yield curve, or earnings collapsing, commodities collapsing, housing rolling over, or is it just all of it combined to show the bigger picture?
Well, when you get the real deal, when you get a real bear market, it's all of it combined. The singularity of the signal is what I like to talk about. In my core signaling process, I have 27 different factors. So those would include things like the yield curve, include things like the price of copper, which has recently crashed and collapsed. You're basically at the point now where there's nothing, literally nothing, that isn't signaling that we've already entered what we call quad 4, of course, where you get disinflation of asset prices, because really up until the commodity collapse that just started only really the last 6 weeks, that was one of the last holdouts. But again, you'd have to have the dollar change. You'd have to have i.e. the dollar start to break down. You'd see a steepening of the yield curve is an interesting one, because of course that would automatically say that we're not only in a recession, but the last of the Mohicans, the Fed, would even have figured that out, and they'll have turned dovish, and then the curve would steepen, as it tends to do in recessions.
One of the charts, Keith, that you've been flagging for a while now is the comparison between Q2 earnings from last year, those unprecedented rates of change, S&P 500 earnings up 87%, to what's happening now on the quarter that's being reported. So far, as you mentioned this morning, down about 12%. So you've called earnings a certified train wreck. You said that yesterday. Can you define train wreck?
Well, train wreck is having negative year-over-year growth in your revenues and or your earnings. And the other part of the train wreck in this bubble's case is that a lot of companies don't have any earnings at all. So you have, there are multiple layers to this, but from the best rate of change acceleration in earnings that we've ever seen in the modern era or otherwise, you have the fastest deceleration. One is just the opposite of the other, which is why we spend so much time modeling and respecting the base effects. I think train wreck too is relative to corporates. Like, these executives running these teams obviously are biased. They have plenty of conflicts of interest in not coming to realize this in real time, or at least being honest about it. And I do think it's a train wreck in terms of expectations. So not only are you going to have a negative situation in terms of earnings that'll perpetuate a furthering of negative expectations, but in the end, people get fired, right? Because once you start to lose money in rate of change terms, or your profits slow and you're spending too much, and now we're starting to hear, we haven't actually formally heard it from Apple's mouth, but we're hearing it from some of the bigger, more impressive companies, that they're going to cut spending. And that's what happens when you're in a negative, not only a negative earnings revision cycle, but an absolutely negative year-over-year earnings cycle.
You hinted at your skepticism about CEOs in terms of their tone and the narratives that they spin, and their relative honesty or lack thereof. What's your impression of what you've heard so far? Not that you are in on all these calls necessarily, but what's your impression of the tone?
Well, it depends on who it is, and I wouldn't say that everyone's lying. There are certainly fraudsters and liars out there. Look no further than the the crypto market, the guys at Celsius, are on some yacht that nobody can find. I mean, there's a lot that comes with bubbles in terms of fraudulence. I mean, as my friend Jim Chanos likes to say, there's legal fraud, and then when people start to lose a lot of money, that fraud obviously gets prosecuted. So you have that community. But then you just have, Mark, you have what I guess it's not really a compliment, but I call them the macro unaware. I mean, you can be macro unaware in the sense that you don't have somebody internally that understands the quads, for example, or the rates of change as they are about to turn negative with a rising probability, which is exactly what just happened. Or you can be willfully blind, right? I mean, I don't think the CFO, well, I know the CFO of Microsoft, to use a good example of a great company, on their only 90 days ago, these guys were painting a picture that definitely wasn't quad 4. It was like the former bubble type guidance on, tech spending and we're in a new era, da 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 da. Well, I would say that's either macro unaware, or it's being willfully blind to a probable path that isn't a bullish one that we were painting. So there's a whole host of issues, and essentially that's why I built the quads and built the macro process, because I knew some management teams were either lying to me when I was a buy-side analyst and then a portfolio manager, or they're just unaware. Both aren't good answers for me, the buy-side investor, if I'm believing them and what I'm believing is not true in terms of the forward outlook.
Now, shifting to the Fed, they're tightening into a slowdown, which you have warned about for months. They've raised rates 3 times. The market expects another 3 or 4 towards the end of the year. Do you think that Jay Powell really is hell-bent on being a latter-day Paul Volcker in tackling inflation, or ultimately, inevitably, damage in the economy and in financial markets will become so acute that he'll have to do what he did in 2018 and pause and or stop?
I do believe that he's trying to be a mini-me Paul Volcker because the market believes that. I mean, all you have to do is look at the yield curve. So the yield curve, to simplify, the short end of the curve, or the 2-year yield, is what the Fed's trying to do, and the long end of the curve is what the economy is trying to tell you. So obviously that's inverted because the long end of the curve is starting to fall and the short end stays up. And that short end is not going to go down until the Fed turntails dovish. And no, I don't think, well, I thought at the beginning of the year, I said, so you're saying there's a chance. I mean, our call in 2018 and Q4 2018 was A, quad 4, that the market was going to crash, but B, Powell would have, poopy in the Powell pants is what I call it. And he would turntail dovish because the boys at Carlisle and everybody else on the streets calling him, and he was a rookie on the job, and he turntail dovish. This time, what you have is a pissed off Republican who's also macro unaware, which is a pretty gnarly combination. Even for a Canadian to hear that, but I mean, he's pissed off, right? He had Janet Yellen try to get him out the door and keep him out of his seat. He did not enjoy that. They kept the process, way long in the tooth in terms of nominating replacements for all the people that were doing not so good stuff, day trading Fed officials and all, and the whole 9 yards. So he's just not a happy man with that, and he sees himself as on the front line of fighting a war that. I don't even know how he fights that, by the way. I can go on and on about this, but here we have the same person who called inflation transitory is the same person who's telling you not to worry about a recession. Well, at least there's consistency in terms of being dead wrong at both points, right? One is a point on inflation, one is a point on growth. Now I think we've gone past the point of inflation being the number one risk and recession risk rising is the real risk. And as he comes to realize that, I think it'll be far too late, and him tightening into a quad 4 slowdown will do what happens 100% of the time, or 100% of the crashes that I've called, is when the Fed's too tight into a slowdown, and this one is the tightest that we've ever seen.
Now, still with the Fed, you've said that you disagree with the basic concept and the mandate of the Fed. And recently you called the Fed effing stupid. They've got no credibility. They lie to the U.S. public. So as you hinted at, you could go on for an hour on this, but can you just sort of summarize your main problem, your main issue with the Fed?
Well, and hopefully, and I use them, it's so infrequent, right, Mark, that I'll drop an F-bomb. But, this is real life, and real people are in real pain. And when you're entering a recession and the Fed's like enforcing more pain onto people with a general unawareness of what situation they have economically and brewing, I think you have to go back to the Fed and its creation. I mean, I don't believe in either the premise or the process of the Federal Reserve. So again, it's not like personal in the sense that people want to make it. I guess if you're at the Fed, you take that personally, and you probably should. But it's what is the difference between the Catholic Church, saying, hey, look, I don't think this that gravity exists or the sun is there or here. You have a fundamental premise that is wrong, that the Federal Reserve or any central market planning agency can bend and smooth economic gravity and predict with some level of precision how that's going to play out. That premise is ridiculous. I could use a lot of different words, but it is a really sad thing that in America today, with all the great innovation and everything that we've had in this country, that the least innovative place is the place that's really at the switch in terms of the financial switch and the market switch. So the process, of course, is an easy one to debunk, because the Fed is wrong. I think it's north of 75% of the time on their forecast. So why would you believe in their process when actually the best part of the Fed's process is to fade it? So instead of I'm not a big fan of all these catchwords that the street talks about in terms of fighting the Fed, et cetera, et cetera. I say just fade the Fed, especially when Hedgeye has got the opposite macro forecast.
Or front run it, as you like to say.
Yeah, exactly.
Right. Now, you're talking about switches. We're going to switch gears here. You had a nice little rant about Jim Cramer and CNBC this morning on the Macro Show. That was entertaining.
God willing, Cramer stays on the right side of the grass for a long time. I think modern day medication really is keeping him in the game. It's awesome. He's in there. He's getting people to believe. And you get to do the other thing. It's awesome. I really do think that.
You continue to rail against them, against crypto zealots, against liars, thieves, and scoundrels. So when you're doing this, especially on social media, does it serve two purposes, rather, in terms of you want to get more people into the Hedgeye tent to find a better way of investing, but also, and again, I think you've sort of mentioned this before, that you need these guys. You love these people to go against as opponents.
100%. I mean, and when your opponent is not telling the truth, incompetent, lacks process, and their premise is ridiculous, why wouldn't you use that as your punching bag? So again, I'm starting with the number one thing to me in starting Hedgeye is creating, and that's the whole point about having a hedge fund process, a world-class process that's transparent and accountable, that can really help people preserve and protect their capital. When I go after somebody that's lying, cheating, doesn't know what they're doing, trying to make a buck on you, the audience, I quite literally feel like I'm doing the people a service, or at least doing my small part in the world to make not just find a better way, but to make it a better place. I mean, it is. I guess it's almost shocking that CNBC exists in the same format that it did during the prior bubbles, and with the same people. I mean, it's unbelievable. I looked it up today. I mean, Seinfeld only lasted for 9 years. That was a pretty good piece of content that they were producing, right? I mean, Jim Cramer. I mean, really? I just, it's amazing. I said I'm grateful, and I was being sincere about that, because not only myself, my family, my firm, our partners, and our community profits from their being gainfully employed. I mean, it's crazy, but it's true.